Hello traders, in this video I'm going to look at brokers, spreads, and charting platforms, just a couple more things to get you set up for day trading. Let's talk about how the spread affects day traders. First, to understand the spread, we need to understand the bid price and the ask price. Hopefully you have a good understanding of these before you start day trading. They were covered in the Forex introduction course, but the price on your chart is always the bid price. It's not like the stock market where it's showing the last price traded. It's always the bid price and then the offer price is above it. So the bid price and the offer price, whatever the difference is between those, is your spread. So the ask price is always going to be higher than the bid. And the difference between the bid and the ask is actually profit or money that we are potentially forfeiting because we often can't capture that amount. The price only runs so far, and the spread prevents us from capturing that tiny little bit at the end. That's just unfortunately the way the market works. It's very hard to get the exact top and the exact bottom because there is a spread there. Sometimes you won't even see it on your chart. You'll see the bid price went up to a certain amount, but remember the ask price was always higher. So when you see a spike up, the bid price, the price actually went a little bit higher than that. It might have filled someone on the offer, but it doesn't show up on the chart because it's only showing the bid price. And that's money that was potentially profited there. Someone could have actually got in a little bit higher than what the price shows. When the price drops, someone might have got the bid price. And that's someone sold right at that bottom price. So the difference... the spread prevents us. Think of it as a cost because typically when the price runs, whatever that spread amount is, we're making that amount less. So if the price runs up 6 pips and we have a 0.2 or 0.3 pip spread, typically we're only going to be able to make 5.8 pips or 5.7 pips out of that maximum, where it's going to be very hard for us to make the full 6 pips. Just because we're either getting in a tiny bit late by having to pay the spread to get in, or we're not going to be able to get out at the exact price we want because of the spread. So we're just giving up tiny little fractions of that move to the spread. Obviously, when it's really small, it doesn't affect us that much. But when you're paying a pip or half a pip, that's quite a bit of the move we're giving up. Ideally, if we can get those spreads down to 0.4, 0.3, 0.2, 0.1, that's going to be a lot better for us. It's also, a lower spread helps us get out of our trades, and kind of the example I just talked about, let's say we're long and we have a 6 pip target. If we have a large spread, potentially we end up getting in later, that's going to put our 6 pip target higher above our entry, which means the price has to move more to get there. Or if we get in at the exact price we want, but there's a really big spread, our 6 pip target could be sitting in between the bid and the ask price, not getting hit. Yet if you had a really small spread, it would probably be right where the order is and we're likely to get out. So your spread actually affects your win rate as well. So the smaller the spread, typically the more winning trades you're going to have, because you're just going to have that little bit extra advantage for the chance that the price is going to hit your target. The same thing would also work with stop losses. The bigger the spread, you may have bigger stop loss, bigger than expected losses as well, because if the spread moves quite quickly with the price, then you could end up with bigger losses as well. So tight spreads, definitely a good thing. We kind of talked about this before too with the EURUSD. That's why I like trading the EURUSD. Small spreads, less slippage. I'd recommend trading with an ECN broker, or brokers typically offer different types of accounts. Choose the ECN option. ECN just means electronic market, and that means trades are automatically executed against each other. If I send in an order and you send in an order and we match at a price, it's like instantly taken care of. Whereas the standard accounts, the ones that are not electronic, they typically have larger spreads, no commissions, and there can be broker intervention there as well. The brokers are matching up orders potentially, not all of them, some they'll send through electronically, but there's often like a little lag And we want to avoid that. In day trading, we need the quick executions. When we hit the buy button, we need to be in there. We can't have any broker intervention. And so ECN options will limit that or eliminate it completely. ECN accounts have a smaller spread along with a commission. So you are going to pay a commission per trade with an ECN account, but the spread's going to be smaller to compensate. So if we think about it this way, if you had a 0.2 pip spread and they're charging you $5 US per 1,000K traded, your cost is actually 0.7 pips. $5, which is half a pip plus 0.2 pips, would be, especially on $100,000, that's 0.7 pips. So that's cheaper than the other account option, which maybe the spread is 1 pip. So this is actually a cheaper option, even though you're paying a little bit of a cost up front. Typically, if you have a larger account and you're making more trades in terms of dollar value, you can lower your commission. So you do have some bargaining power too. Maybe they're offering $5 per trade, but if you become a fairly active trader, you can probably go to them and say, hey, give me $4, give me $3 per 100K, and maybe they'll accommodate you. So you do have some bargaining power there. If you're in this range, paying about $1 to $2 per 100K, that's very low. That's a really good price. $3 and under is good. If you're up in the $5 area, that's getting a little more expensive, but you're still okay. You're better than what a typical account offers, a non-commission account. So these commission accounts are still good. If you're getting above $5, that's going to get pretty expensive, because when we add this, kind of like this, run the comparison, add the typical spread plus the commission, and see where you're at. If you're paying $7 per 100,000 and your typical spread is 0.2, 0.3, you're paying a pip anyway. It's just broken up in a different way. You're paying cash for 7/10 of it, and you're paying 0.3 pips for the other 3/10, but you're still paying a pip overall. And we want to keep our costs down into this 0.7 or lower when we add up this plus our commission cost. ECN accounts don't typically limit day traders on where they can place orders or how long trades have to be held for. Some conventional non-commission accounts do, and that's the other reason why we really want the ECN account. You want to pick a broker that says scalping allowed. That's going to mean that they don't care where you place your orders. You can punch in and punch out 3 seconds later if you want, or you can put in an order, put your stop loss 2 pips away. They're not going to care. I was checking out one broker the other day, and I haven't seen this too often, but they had a minimum 2-minute limit on their trade. So they had great spreads, great commissions, but you had to hold your trade for a minimum of 2 minutes. And what that means is that you could potentially locked into that trade even when you don't want to be if you're under 2 minutes. And that would be a problem for us, because while most of our trades do last longer than 2 minutes, if we enter a trade and it quickly moves to our stop loss, they may not let you out of that trade simply because you haven't been in that trade for a minute. That could be very costly, because the price can move a long way in 2 minutes before they let you out. So that's a pretty scary thing. So we want to make sure scalping's allowed, that they let you place orders. You can email them and ask them, do you let me place orders inside the spread? If they say yes, you'll know it's a good account for day trading. No limits on where you can place orders, or no restrictions on where you can place orders, and no time limit on your trades. Those are things that we want. Let's quickly talk about another element of setting up your charts. For all the strategies, you're going to want to have a quick trade setup. So this is how we can place our trades really quickly. MetaTrader 4, MetaTrader 5 are really good for this. They're offered by almost all brokers, so it's an option. If your broker has another trading platform that they use, they probably have something similar to how this is set up, so it still should work. We want to be able to place our orders accurately and efficiently. So on either of these platforms, MetaTrader 4 or MetaTrader 5, open a EURUSD chart, then right-click on it and select Market Depth, or else you can just select Alt-B on your PC. This will open a quick trade window put it wherever you like on your screen. You're going to have to use it often, so you might want to lock it on the side or just have it floating maybe up in the corner somewhere. And it basically works like this. We have the position size in the middle, and so this is in fractional lots. So right now this would be a micro lot, 0.01. If it was 0.1, it would be a mini lot, and if it was 1.00, that'd be a standard lot. This is your target, this is your stop loss, and these you want to, if you're thinking in pips, you want to always multiply these by 10 because they're, as you can see, it shows fractional pips here along the top. So it's, each one of these is 1/10 of a pip. So this is showing basically 9/10 or one pip of movement, just all these price levels. So if you had a 5 pip stop loss, you would put 50 in here because your 50 fractional pips is what your stop loss is. And let's just say we put a target at 10 pips, we'd put 100 in here. So whatever your pip stop loss is, multiply by 10. So if you had a 2.7 pip stop loss, you would put 27 in your stop loss. For the record, I always use market orders. I just hit these buy or sell keys. So as soon as the price moves above, you'll see all the entry techniques when we get to the strategies. But I'm always entering as the price moves. I'm buying as the price moves above a price point, and I'm just going to click buy. Or if the price drops below a certain point for an entry, then I'm clicking sell. And I just use the market sell keys. You could technically set up your order in advance if you wanted to by selecting from these little arrows here for buy and sell. I don't like doing that. I find I just like setting my orders via this way. Just as soon as the trade triggers, hit the buy or sell keys. So this is a very quick way to get set up for efficient trading because we have our position size set on it. We can change this on the fly very quickly, and as each trade's occurring, sometimes our stop loss will change from trade to trade. One might be 3 pips, one might be 4 pips, so we can just punch in real quick 30 for our 3 pip stop loss, 40 for our 4 pip stop loss as that trade comes up, and just click our buy or sells to get into the trade. So a really efficient way to trade. MetaTrader 4 and 5 work very well for trading, as I just showed you. Very efficient style, have our stop loss target all sent out at once. Really nice. But I don't personally like the MetaTrader charts, and there's nothing wrong with them. It's just I do a lot of writing and drawing on my charts throughout the day, and so I use an alternative. I use TradingView. So on one on one screen, I have TradingView, and on my other screen, I have MetaTrader. So I'm placing my trades in MetaTrader, and I'm doing my analysis and my writing all over my charts on TradingView. So there's a free version of TradingView just on tradingview.com. You can also, if you kind of want to hack, I guess, is you can go to investing.com, and they offer the high-end TradingView package for free. You'll need to open or sign up for a free account with investing.com so you can save your settings, but you'll be able to get the high-end TradingView without paying for it, because investing.com has paid for it for you if you open a free account with them. And there are a couple limitations. It's not quite like having bought TradingView yourself, but if you're looking to save some money and you like TradingView charts better than MetaTrader, you could use that as an option. This is not a requirement. I just prefer MetaTrader charts. As you'll see, I like to draw all over my charts. I like certain tools that TradingView has. So it's just something I've chosen to do. But if you want to do all your work on MetaTrader and do your analysis on there, that's fine. So no problem there. I just do like having this separate chart. Before trading real capital with any broker, set up a demo account to get used to everything and see if there's any issues. If you're considering a few different brokers, open a demo account with each. You may find one better than the other, even though it may not be the best choice on paper. So for example, most brokers will say that their minimum spread is 0.1 pips, but when you open the demo account, you actually trade with them during the day, you may see this one's 0.4 pips, this one's typically 0.2 pips, and then you can add in your commission costs and see which one's actually cheaper. When you place orders, are those orders quick? Are they almost instant? That's a broker you'd probably want to be with more. So look at the spread, look at how slippage is. Just consider a few of those things before you actually go with a broker. Do your experimenting in there. Just place some orders. It doesn't matter if they adhere to a strategy. Just hit your buy and sell buttons to experiment. See how quickly those orders fill. Is there any slippage? That sort of thing. How much are your commission costs? How much is the spread? All that sort of stuff. Once you decide to trade with a specific broker, that's when you're going to want to get serious, and then we stop doing those random trades, of course. We want to zero in on the methods and strategies that you're going to learn in this course, or if you're using some other strategies as well, but you only want to do those trades. The experimenting stops. That's only done with the fake money. And even if we're still in a demo account, once we've decided, okay, I'm trading with this broker, then it's time to get serious. We want to start eliminating those kind of random trades and just focus in on the strategy trades. So any trades we take after that, once we picked our broker, then we're just executing strategy trades. We'll talk more about this as we go through the course, because practicing is really important, and having protocols for what we do, even in a demo account, because we're starting to build that skill set, and we don't want to build bad habits by saying, it's free money, I'll just try this and this and this. And that's not the type of mentality we have, because if we have that in a demo account, we're probably most likely going to bring that in with real money, even though a lot of people say, I would never do that with real money. But if you're not going to do it with real money, why do it with the demo? So experiment to find the broker you like. Just place a few trades, see how they operate, but start as soon as you can. Start building in that discipline where, okay, now I'm set, ready to go, and I'm only using these specific methods to enter trades, and the experimenting stops. So I'm just going to go back here for 1 second. I have put below this video a couple of brokers that I've traded with or like, so some recommendations or ones to consider if you don't have a broker yet. Again, those aren't my endorsements or anything. I definitely want you to check them out first before you proceed with any of them, but just some options to shortlist, I guess you could say, and then just go through them each and see which one works best for you. In the next video, we're going to talk about when to trade and setting up our charts.